Welcome in, everyone. Happy Thursday afternoon. We are so glad to have you with us today. I am super excited about our topic today, which is everyone's favorite topic, looking at how to save on taxes. Last month, we spent a little bit of time talking about how to grow when you're experiencing some of those growth challenges. And one of the ways that we can leverage our growth is by hopefully taking some of those tax savings and throwing it back into growing your business. Things to expect today. We hope that you'll get to learn from some of the experiences that me and our guest speaker will be able to share with you. We're going to use some real life case studies of clients that we've actually worked with. We're also going to walk you through some proven strategies on how to leverage money that would have otherwise gone to the government, take that and redirect it back into the growth of your business. And lastly, we hope to have an interactive discussion. So if you have any questions along the way, we would just encourage you to pop out that comments bar on the right-hand side and just drop us a little question. We'll allocate some time at the end of our conversation today to make sure that we're answering those questions. If I didn't say it before, my name is Zach Thomas. I own a financial planning firm called Growth Horizons Wealth Management. We are located in Georgetown, Texas, which is a little bit north of Austin, Texas. I've been doing this for pretty close to 10 years now. And we're just super excited to be able to share some of the experiences that we've had working with our business owners, understanding uniquely the challenges that they experience. And taxes is definitely at the top of the list in terms of just opportunities for us to be able to create some real value. As we kind of transition in, I want to take some time and introduce Cliff House. Cliff is a third generation tax firm owner. So that means that not only did his dad, but also his grandfather own and operate the tax firm that he is currently operating. Cliff, and we'll get into this a little bit later, Cliff and I have known each other for about 2 years now. And what I love about Cliff is that he is a tax strategist, not a tax preparer. So that means that he is very interactive. He's very proactive with the clients that he works with to help them come up with strategies that they can put into place to help save on taxes instead of just waiting until you get that tax bill in March, April, May of every single year. Cliff, has a varied background in terms of industries that he's worked with, but has a lot of experience working specifically with small business owners. And in the time that I've worked with Cliff, it's just been a joy to be able to work mutually on some of the clients that we share together. So that being said, I'm going to go ahead and introduce Cliff in. Hey, Cliff, how's it going, man?
Hey, Zach. Hey, it's great to be here. Thanks for having me on. Always love an opportunity to talk tax with business owners. I not a lot of people get excited about it, but I do.
Well, I was just happy that we could carve out some time 9 days before the next filing deadline. So thanks for
Yeah.
allocating some of your precious time for us during what I know is a really busy season for you and for the firm. I want to kick off our conversation with just kind of talking through maybe some examples of where we've both seen maybe some common misconceptions or mistakes along the way. Could you maybe walk us through what are some of the most common scenarios that you see, maybe misconceptions or misunderstandings whenever it comes to how to come up with a tax strategy with some of the business owners that you've worked with over the years?
Yeah, I mean, I think a lot of it comes down to understanding what our goals are, and a lot of people don't think about that part because when you're trying to plan and strategize, we don't want to just save tax money for tax money's sake. We want to plan around your business to help it succeed and grow, and taxes is part of that. So having the holistic approach with that, also understanding the dynamic of we're avoiding taxes. Yes, we want to try to avoid some, but we're not evading. Evading is bad. Avoiding is okay. Evading is bad. So we want to make sure that we're doing it in a legal way and doing it in the best way possible. So when I see business owners, one of the biggest mistakes that I come across business owners getting started, because a lot of times they're experts in their field and they say, hey, I'm going to do this on my own. So they break off and they start their own company, which is awesome. And they're really good at what they do, but they're not really familiar with running a business yet. And so
Sure.
one of the biggest things that is a hurdle for them is actually keeping track of the money.
Mm,
Well, I talked to my business owner and I said, we have to take care of mom. We have managing our money. And if we take care of mom, mom will take care of us.
mhm,
And that is, it's not fancy, it's not exciting, it's not sexy, but that's the foundation of all other opportunities when it comes to taxes and financial planning. And so managing our money well is really the biggest start where we have, that's where we have to build on. And so a lot of times that's kind of takes a back seat when they're trying to get the business doing everything. And then it's like, oh, well, I'll get to that eventually. And then when they do eventually have to think about it, then it's like really stressful and hard. And you're going to miss opportunities because trying to go back and untangle things is very difficult.
sure.
So really that's the foundation, is being able to have a platform where you know where things are and things are separated between you and your personal stuff, and you have books. And that's, I mean, that's really one of the biggest foundations that I see.
Well, I'm going to jump in here and I'm going to take a stab and say that it's probably not a best practice to wait until March or April to start thinking about getting all your books in order and thinking about your tax strategy. So maybe it would be helpful for some of the people listening today to just kind of explain the difference between what it looks like to work with a tax strategist compared to working with a tax preparer, which I think is what most people's
Yeah.
experience is, working with their accounting firm.
No, absolutely. And there's a lot of uh times where it's like taxes, well, it's just a necessity. We just have to do it. So at that time of the year, here's the stuff, just get it done. And when you're starting to get into things like running your own business, you need to have a little bit more invested into that process besides just like, okay, let's just get it done. And so you got to have an investor's mindset in a lot of areas. But as you become a business owner, investment mindset in this area as well. You're investing the resources, the time, the money to make sure that it's done well and it's done right, so that you have those opportunities. And so, yeah, you're expecting a monetary return, of course, but you're also going to get a return on that investment in your sanity, your peace of mind. And you're not going to be stressed when it's like, oh, it's tax time, it's March, we got to get this in, because you already have planned it out. You know what's happened, what's going to happen, and you just have to do the compliance. You have to do the paperwork. You're not stressed about it because you've already planned for it. And also, it helps you in confidence. I mean, it'll make you a lot more confidence. And as a business owner, that's important because um, I do a lot of business podcasts and things, and I like Alex Ramosi. He's got a lot of really good stuff to say. But one of the things when I was listening to him, he was talking about the I don't remember exact quote, but he was talking about the speed at which your business grows and you
Sure.
succeed as a business. A lot of times depends on your ability to make decisions.
Sure.
And so if you don't have the information, it's hard to make a decision and you kind of wait on it. But if
Sure.
you have the information, you have the confidence to make a decision, you're going to be able
Yeah.
to make those decisions and grow as a business. And that's a big piece of it, the managing your money, having somebody to help you understand the opportunities that are available. Then you can make those decisions
Yeah.
and you can accelerate your growth as a business.
Yeah. As you're going through and explaining that, I know that one of the clients that we've worked with in a fractional CFO engagement, we formally engaged with them about 8, 10 months ago, somewhere around there. I was doing some informal, stuff with them beforehand, but blue collar, industry, think kind of, construction. They were just doing all of it themselves, and so I would ask them like, hey, who's your accounting firm? Who is your bookkeeper? And it's like, oh, well, like I'm the bookkeeper and I talk to my tax guy, once a year whenever it's time to file my taxes. And I'm just, over here. It's like, hey, man, don't you want to spend more time out in the field, like doing what you do well, building the business? Do you really want to be allocating I don't know, 5 hours a month towards going through and combing through your books? Like, is that really the highest and best use of your time? And so that was like the first thing that, whenever we entered into a formal engagement, I was like, hey, man, we've just got to get this off your plate. This is not a good use of your time. You probably don't wake up early in the morning feeling super excited that you get to comb through a bunch of expenses. So like, let's just take this off your plate. And so the first
Yeah.
thing that, we were able to do is just offload that entire bookkeeping and accounting system. And
Yeah.
along the way, what we did, I set the expectation, hey man, it's going to require a little bit of work. You're going to have to roll up your sleeves. We're going to have to build some systems. It's going to
Hmm.
require a commitment of time. But I promise you, if you do this for 3 months, you're going to be spending way less time doing on this. It's going to be small little touch points along the way. And
Yeah.
the other benefit is now you can actually take a look at the health of your organization. Because
Right.
beforehand, if you don't have good financials, if you don't have good bookkeeping, it's like, well, how do you take a look at what you've done in the past?
Yeah.
Like, how do you know what your profitability is? How do you know what your margins? How do you make good decisions about the future of where you're going if you don't have tangible data to be able to back that up? And so
Yeah.
I can tell you, 9 months, 10 months into the engagement, they are just super happy that we have completely removed that from the plate. They are very happy with the accounting firm that we set them up with. We have a monthly touch point where we jump on the call with the bookkeeper. We talk about, hey, what's gone on, over the past month. It takes maybe 30 minutes. And then we spend the rest of the time just talking about strategy on a going forward basis. Hey, based off of our numbers over here, here's the
Hmm.
things that we want to do. Like, we want to bring on some more people, onto the team. We want to buy that next big piece of equipment. Now that we actually have good books, can we afford to be able to do those things? And what's the risk and reward
Hmm.
associated now that we have good, clean data? And then
Yeah.
the other side benefit that I'd normally try to coach people through is, hey, at some point along the way, if you're growing really fast, you might need some sort of capital infusion. That might be bank financing, that might be bringing in a private investor. And like, I can tell you, if you go knock on the door of any commercial banker, the first thing they're going to ask you for before they even open up a bank account for you, it's like, I want to see your tax returns
Yep.
and I want to see your financial statements for the last 30 years. And so if those aren't cleaned up, if you don't have the confidence that you can tell the story of your business through the lens of numbers, it's going to be really challenging for you to get that outside financing. And if you don't believe me,
Yep.
just go watch an episode of Shark Tank, because that's almost one of the first things that they ask them. Hey, let's get into the numbers. I want to hear your numbers. So
Yep.
I just see so many like incredible operators that, Joe the plumber is great at fixing people's toilets, but the reality is, like, he doesn't like spending time on doing the
Yep.
bookkeeping, and maybe he doesn't have the skill set to know how to manage that professional relationship to really extract the value out of having a good bookkeeper and having a good tax strategist. So have there been any examples for you where you've I guess kind of seen people go from, let's say, a little bit disorganized, with
Hmm.
what they're doing, to maybe coming into an engagement, your firm having the opportunity to offload some of those and then freeing them up to really allow them to do what they do best, which is continuing to grow the business that they have?
Yeah. No, 100%. Absolutely. And a lot of times it's twofold, because you have the bookkeeping part of it and then you have the tax part of it. And we primarily focus on the tax part of it. We do a little bit of the bookkeeping,
Sure.
but if there's they need a lot of bookkeeping help, we have referral partners that we use, because the tax part is our focus.
Sure.
But so there's really two sides, and a lot of times the bookkeeping is the foundation, like I
Hmm.
said before. And so once they get that, a lot of times they're it's eye opening, because they can actually see what's going on. Whereas before, it's like there's just a list of things, of transactions. What does it mean? You
Sure.
know, and it also helps on the tax planning side to be able to then look at the numbers and help them digest it to make it make sense. Like, okay, well, here's opportunities available that we didn't know they were available until we got organized.
Sure.
And because we have to be able to see that data. And then we can also even make suggestions into their business. Cause a lot of times, yeah, we're tax strategy, but we try to be holistic and be like, hey,
Yeah.
as a business, how can we help you obviously save taxes, but ultimately to put that back in and grow the business, what maybe you could spend more on marketing this year, and so it really is a lot of times, like you said, a transition because it's hard. It's like, it's a change is hard.
Yeah.
But once you do the change, then it's freeing. It's like, oh, I, I should have done this a long time ago.
Yeah, that's great. So I know that one of the things that came to mind as I was hearing you talking is I've been seeing, and especially because I'm in the space, offering fractional CFO services ourselves, seeing there's a lot of misconceptions around, let's call it, what building an accounting team could look like. So I think it would be helpful, Cliff, if maybe we had a short dialogue about the difference between what I really perceive as the four layers of building a strong accounting and financing team. So I'm going to start off because you already kind of set the expectation. Bookkeeping really is the foundation of just having good financials. So I would put a bookkeeper at the bottom of the pyramid, so to speak. And then if we were to jump the next layer up,
Mhm.
I would say that's probably an accountant or an accounting team. And then above that, you have generally a controller. And
Mhm.
then above that, you would have like a CFO. So could you go through and maybe just share just really quickly how you would separate or maybe establish some definitions between each one of those different layers? So
Yeah,
that way
no.
people who are hearing fractional CFO and controller and bookkeeper, it's like, what does all this mean? Like, you're all just a bunch of
Oh,
nerdy finance people, right? You all do the
yeah,
same things.
they're overwhelmed right now.
Yeah, yeah.
So, well, a lot of it's okay. We're talking about small businesses. That's
Mhm.
kind of a wide range.
Sure.
That's a big range. So, well, you could have two different small businesses listening to this that are in very different situations, and so we got to kind of address what that means. Because if you're, well, like we talked about earlier, just starting out, you're a tradesperson, you're doing your own thing now. You're starting off small,
Mhm.
right? So you're not going to have that same need or capacity for all four of those roles, right? And so a lot of times you do want to build a team around you that's outsourced. So having somebody that's like, hey, this is a bookkeeping firm, they do books for lots of people, and they're going to do your books and help you with that. And you pay them to do that. It's a service. And so a lot of times that's where people start is with a service. Well, they start doing it themselves and then they realize very quickly, I shouldn't be doing this.
Yeah.
Or they have me tell them, you need to fire your bookkeeper. And they say, but I'm the bookkeeper. I say, yeah, you need
Yeah.
to fire yourself. And so, but hiring a service to do that is the first step.
Mhm.
And it's a very basic service, but it's the first step in your journey as an entrepreneur, as a small business owner. And then as your business grows, then you start to add on other pieces, right? And the metamorphosis will complete once you get to the top level where some small business owners are right now, where they're like, okay, well, I've outsourced bookkeeping, I have maybe a fractional CFO, like I have these people, but I'm starting to get big enough where I need to bring it in-house.
Mhm.
And that's kind of the full journey, is starting with just the bookkeeping service, adding some other layers and saying, okay, now we can bring in a team. And that's when you get more towards what you're talking about of having the in-house bookkeeper, an in-house accounting team, an in-house CFO. And that's when you're like, you're moving and grooving.
Mhm.
You're cooking with
Yeah.
gas now. You got lots of things that you can do, and so, but that's a journey. You're not going to get there right away.
Sure.
So but that's why we have to kind of
Mhm.
talk about that as a journey of a small business, because small business, that's a pretty big category.
Sure. Yeah, that's good. I'll just kind of share, my interpretation of those four different layers, and then we'll shift gears and talk a little bit about deductions, everybody's favorite conversation. I look at bookkeeping is the foundation. This is the person that's going in and categorizing expenses in your
Mhm.
QuickBooks, so that way you can pull up your profit and loss statement and your balance sheet, on a monthly basis or on an annual basis. Your accounting team maybe has some expanded capabilities. So maybe this is somebody that is sending out invoices. Maybe it's somebody that's chasing, dollars down. they're going to be finance adjacent, but they're going to be a little bit more encompassing than maybe a bookkeeping company will do who's just going through those transactions. A controller, is probably another layer where the controller is probably managing a team of accountants. So when you get enough complexity that you need multiple people on the team, a controller is, somebody that's going to help manage the entire team. And then generally at the pinnacle of that, the top of that pyramid, we would put the CFO, who really should be a strategic thought partner to the CEO, thinking them through, okay, here are my growth goals of where I want to go as an organization based off of where we're at from a financial standpoint. What do we have the capacity to be able to accomplish? I love to tell my business owners, you can do anything, but you can't do everything. We're all limited by resources, right? And so we have to learn how to be able to prioritize the decisions, that we make. So for anybody who, is maybe hearing some of this vernacular and doesn't understand, hopefully that's been kind of helpful for them to, understand. So let's shift gears a little bit, Cliff, and let's talk about, we're in the middle of tax season. Maybe it's too late for some of these deductions, but just generally speaking, what are some of the common deductions that you see that most small business owners should be thinking about and should be taking advantage of?
Well, I mean, the list is infinitely long depending on your business. So let's just start off by talking about deductions in general. So when we look at what can we deduct for our business, the rule that the IRS has is these two words. Is it necessary? Is it ordinary? So you got to look at everything through that lens for your business. Is it necessary and ordinary for my business to function and to make money? And if it is, that's an expense. That's a deduction for your business. And so going through that in your mind, that's one of the reasons it's so important for people just starting out, like we talked about earlier, to have that separation of personal and business, because we want to keep all that separate. Now, as we get bigger and we talk about, like you were saying with the structure of having the team, you're way past that at that point.
Yeah.
But everything that the business is doing, spending money, those most of the time are deductions. And so as a small business owner, you're going to have things that you can think about that a lot of businesses might not have. Like sometimes you're going to have an office, right? If you're a small business owner, you might work out of your home. You have a home office. You're going to have mileage if you go places. You can deduct mileage. If you have education, like you're going to learn continued education to do your job better. Those are all expenses. Any kind of professional expenses that you have, legal, accounting, all those things. So if you're paying somebody to do the books, that's an expense. So these are all one of the things, though, that I think that if you look at things that are commonly overlooked, one of the things that I see is when you're moving and grooving and you're like, oh, hey, we got some extra money. We want to make a difference in the community. We're going to make charitable donations. And it's like, great. And then we go to do the tax return and they're like, well, what happened to my charitable donations? It's like, well, that's for these pass-through entities. That's not an expense that flows to the business owner to itemize, and they may not itemize, which means nothing. That's just money that you gave away. You don't get any benefit.
Who doesn't know what that means, most people are going to fall into the standard deduction, which means that you just get an automatic deduction of $30,000. If you don't have line item transactions of individual things that you're writing off for your deductions, you would fall into that standard deduction. And a charitable contribution is not going to add on top of that. You have to be over here itemizing each individual deduction over that $30,000 threshold.
Yeah, and with the Tax Cuts and Jobs Act, they made it a lot harder to itemize. Sure. And so a lot of people, they're like, but I have all this stuff. I'm like, well, if you want to itemize, it's going to be less than the standard. So it's not advantageous. But getting people to understand that. But back to the charitable donations, we just want to tweak a little thing to make it where, hey, you're still giving, you're still being charitable in the community, but you can also give a little benefit to your business. And the way that you do that is you say, okay, well, this organization that I want to support, they're having an event. I'm going to sponsor the event. So I'm helping the organization, I'm donating, but now my logo, my brand, my name is all over that event. It's on websites, it's on posters. This is now a marketing and advertising expense.
Yep.
So now it's a deduction for your business. And so a lot of times there's little nuances like that that you may not think about, that having somebody on your team that does think that way can say, hey, let's make sure we do it in this way so that we can have the benefit of it.
Yeah.
So that's a common one that I see a lot of small business owners come in and they're like, well, what about this? I'm like, well, next time,
Yeah.
sponsor.
great.
So that's one of the things.
I know that one of the things that I get asked a lot about is paying your kids through your business. And I know that there are some good ways to do that. And there are some like maybe not so good ways to do that. So could you help explain, what are the good ways, for us to think about when it makes sense for us to be able to pay our kids through the business?
Yeah, no, this is a popular TikTok strategy. Like, ooh, yeah.
Yeah.
And there's always truth in these. It's just that they don't explain everything. So it is a fantastic strategy, and it does legitimately work. And it works well with you too, because the kids can go ahead and start putting it in a Roth, like, hey,
Sure.
that's great. So
Yep.
there's lots of good things about it. You just need to make sure that you're doing it right, so that you don't ever get a second look by the IRS and go like, you can't do that. So when I say that, you have to make sure that all of your documentation is done well. Everything has to be documented, that they're actually employees of your business. You're not just giving them money, right? They're employees. They're doing a job. And this is the part that a lot of people skip over. It needs to be ordinary, necessary for your business, and a reasonable wage. So the way that people get it twisted is that they'll say, oh, well, I did a photo shoot and I had my kid in the photo shoot and I paid him $10,000. Well, okay, yeah, you can pay him to be in the photo shoot,
Sure.
but that's not reasonable. You could go get somebody down the street for $500
Sure.
and do a photo shoot. And so it has to be reasonable, and it also just has to be them actually doing something. I mean, and it could be cleaning the office. Hey, that's great. But it has to be doing something.
Sure.
And so that's really one of the biggest things that they leave out in the TikTok strategies. And the other thing is they have to be a W-2 employee. So they have to receive a W-2. And there is a nuance between a sole proprietor partnership and a S corporation and a C corporation, because you have to have a W-2 in all of them. But in a corporation setup, you do have to withhold FICA, Social Security, Medicare. But when you're a sole proprietor or a partnership, you don't have to withhold Social Security and Medicare. So there is a little bit of a nuance there, depending on what your setup is. But it is a great strategy if you can do it. If your kids are interested in doing stuff, absolutely do it. It teaches them what you're doing, business, gives them an opportunity to make some money, and even connect with you if they are doing that, to start investing in a Roth, because hey, that's tax-free. It's tax-free income that you're keeping in the family, and it also is a deduction for your business. So it's great all the way around.
Yeah. So for anyone who's not familiar with what Cliff is describing, not only do you get to pay your kids typically at a lower tax rate because they probably make a lot less than you do, so you get the deduction on the business side. They're getting taxed at a lower tax rate. You can take up to $7,000 of those W-2 wage earnings, and you can now put them into a Roth IRA, where those funds are now growing tax-free. What a lot of people don't realize is the principal that you put into the Roth IRA is still eligible for you to pull that back out in the event of an emergency. We generally discourage that because it's so hard to squeeze the dollars into it. But if something did pop up, you could pull the principal. It's the growth of the funds that you can't touch. Those are subject to the age 59 and a half, rules, where you have to pay taxes and a 10% early withdrawal penalty if you're touching it before that age. So for anybody who's not familiar, since we're on the subject on retirement savings, why don't we spend a little bit of time where I think we would both agree for most small business owners is probably one of the areas that they can squeeze in some larger, deductions, which is through setting up retirement plans. Do you want to go through, or would it be helpful for me to go through some of the different types of retirement plans?
Yeah, I mean, absolutely. This is definitely a big way that you can have easy current year deductions and be saving for the future. Because I mean, who knows if Social Security is going to hold up? So, it's like a dual purpose, and it's great. And ultimately, talking to somebody like you is ideal because there are nuances with different kinds. I mean, and sometimes people are like, wait a minute, what? I just want a retirement account. They all have all these names: solo,
Yep,
simple,
sure.
SEP, all these
Hmm.
different kinds. So yeah, go through and just talk about some of the nuances of them. And a lot of times it really depends too on your business structure. Do you have
Hmm.
employees?
Yep.
How do you want to distribute that for you and them?
Hmm.
And so there's a lot to talk about, with you about it.
Yeah, that's great. So I would say, just kind of generally speaking, the way to think about it is, if you're a solo entrepreneur or a family owned business, a SEP IRA can make a lot of sense. It generally has larger contribution sizes that are tied to how much you pay yourself. I think it's around a 20% of whatever your W-2 wage is. Cliff can double check
Yeah,
me on that.
25.
25%. It has a pretty high threshold. It's somewhere around $60,000. It changes every year, so I forget what the exact number is for 2025. So that would be, one sleeve. If you have
Mhm.
employees, I'm sure most people are familiar with the 401k. And if you're hearing me talking and you're like plugging your ears, because like we try to look at 401ks, I promise you, um, the landscape of 401k administration has changed a lot over the past 2 or 3 years. So with the Secure 2.0 legislation that took place in 2022, I believe, the government is now offering tax credits for you to basically get that plan up and running. And whenever
Yeah.
they created those tax credits, there were all these new financial technology companies, called fintech companies, that started popping up that wanted to basically gobble up those tax credit dollars. And so there's all kinds of new platforms that are really good for small business owners that, let's say, have less than 10 employees. So whereas a couple of years ago, I would have said, hey, if you're not willing to spend $2,500 to $3,000 in administration costs, it probably doesn't make sense for you to look at a 401k. I mean, that number is really, really low on a going forward basis. Most of the platforms we're looking at $1,000, $1,500. But the nice thing is there's some additional tax credits in the first couple of years to
Mhm.
offset a lot of those startup costs. So if you're thinking about it, if you want to incentivize your employees to stay around, but we all know how hard it is to find quality people. It's a whole another challenge to retain those people. And it's almost become an unwritten rule that if you don't have some sort of retirement account, you know um, I'm probably going to be looking at some opportunities that I'm getting some sort of retirement account, because that's a big opportunity, especially for a lot of millennials in our age generation. It's just something we've come to expect. So that's an incredible opportunity, right now, that people can be taken advantage of. And then I would say the next level above that, which might not apply to as many people, but it's called a cash balance plan. And these are generally more beneficial for owners that are a little bit older. There's a couple of maybe family members that are working in the business itself. And the reason we really like cash balance plans is because sometimes we can squeeze five, six, $700,000 of tax deduction into those cash balance plans. So they tend
Yeah.
to be really attractive for, let's say, owners who are very cash heavy, that maybe aren't as aggressive with their growth strategy. They're starting to think about maybe an exit in the next couple of years, or transitioning it to the next generation. This can be really attractive strategies for you to squeeze some larger deductions into those, let's say, final 5 to 7 years before
Yeah.
hopefully you're going to be drinking some mojitos on the beach somewhere.
Ooh.
Yeah.
Yeah, no, that's great. I love that.
Well, why don't we spend a little bit of time, and let's give some practical advice on, we've covered a lot of territory. What are some of the common tax strategies that people can put into place, today in terms of creating some sort of action plan that people can walk away from based off of our conversation today?
Well, I mean, I do want to mention one thing that we didn't really dive too deep into, which is a
Hmm.
great tax strategy to think about. We kind of alluded, we danced around, but it is entity structure.
Yeah.
Because when you're a business owner, a lot of times you just get started and you're like, well, I'm a business. Well,
Hmm.
okay, well, yeah, but there's different ways that you can be viewed by the IRS. And so we just want to talk about that. And a lot of times people get confused and like, oh, an LLC or an S Corp so I just want to bring some clarity to that. An LLC is the building block of your entity structure. It can be viewed and taxed as a disregarded entity, which is the sole proprietor on your personal tax return, a Schedule C, if that's what you're doing right now. It can also be viewed as a partnership if there's multiple people on it. It's a 1065 tax return. You get a K1 from that. And then it could also be viewed as an S corporation, which is a 1120S tax return, and you get a K1 from that. But you also need to have a W-2, reasonable wages, as a owner and employee of that business. And then a C corporation, the kind of the big daddy, that doesn't usually happen a lot. But if you get really big and you're getting investors and all that kind of stuff, hey, that's great for you to do. But that is its own separate thing. It is taxed itself. It's not a flow through entity like an S corporation or a partnership. So that kind of gives you a good picture, and this is a great illustration to be able to kind of see. But the LLC is the building block. And so when you're looking at getting a business, you get the LLC. And as your business morphs and changes and grows, we can alter your structure, your view from the IRS. So I have a perfect example. There's a guy that I'm working with right now, and he is a sole proprietor, but he's starting to make a lot of profit. And so it's time to start talking about, should we say, hey, IRS, we want to be viewed as an S corporation now, because there's a lot of potential tax savings, especially when we talk about the Social Security, Medicare, the self-employment tax. Because when you are a business owner as a disregarded entity or even a partnership, all that profit that you're getting is going to have self-employment tax on your tax return. That's above and beyond your income tax. So a lot of times it's kind of a sneaky tax that you're not really ready for. It's like, wait a minute, there's an extra 15.3% that is added on my tax return because you didn't have FICA withheld from a paycheck, because that's just your profit as a self-employed person. And so you got to be able to plan for that and be ready for that. But on the flip side, once you start to get to a certain profit level, it'll make sense to switch to something like an S corporation. That's called income shifting. We're shifting the income to the S corporation, and now you get a reasonable wage. You're an employee now. You get that W-2, so you have the FICA withheld, and then the rest of it, the profit will come through to you on a K1 that doesn't have that Social Security, Medicare taxed. It's just income.
Hmm.
And so that's one big strategy that people can use. I know that when we were talking about his situation, I started looking at his numbers, and yeah, he saved like $20,000.
Yep.
I mean, it can be a big deal,
Hmm.
but that's a case by case basis. It's not a one size fits all. We have to look at your situation. Does that make sense to do? Then we need to absolutely do it, because a lot of times with these, there are extra costs involved, kind of like you were talking about with the retirement program. There are extra costs. Right now, it's a great time because those costs are being covered with tax credits.
Yep.
But in these, there are extra costs involved with having another tax return, having more administration, having this other payroll or whatever it is that you haven't had in the past. We have to just make sure cost benefit analysis, does it make sense? Because if I'm going to spend $5,000 to save $3,000, it's not a good fit. If I'm
Sure.
going to spend $5,000 and I'm going to save 20, I'm going to do that every day.
Yeah.
And so a lot of times it's about talking through the scenarios, the situations, what is available and what makes the most sense for where we are and where we're going. Because
Hmm.
sometimes it even makes sense to be like, okay, well, our trajectory of growth says that we're going to be there quick. So why don't we just go ahead and do that,
Sure.
just so that we're already in that motion. So sometimes you just got to talk about the situation.
Yeah.
But yeah, that's a big strategy. I think that people don't fully understand.
Mhm.
They hear about it, but they don't fully understand that
Sure.
concept.
Yeah, that's good. Yeah, so there were 5 things that I heard or stood out to me from our conversation today that I think people can walk away with some really tangible, action items. So, number 1 is evaluating your business structure. Could be some really, incredible tax savings similar to you. I was working with somebody who had been structured as a C corp for like 25 years. And yes, it made sense in the 90s, whenever they
Mhm.
set it up. But their accounting firm partner had never consulted them through the benefits of setting up an S corp. And when we did some of the math, it was like over $100,000 in tax savings that it ended up being very worthwhile for them to go through and restructure as an S corp. So number 1 is just evaluate your business structure on a irregular basis. Secondly is just have good books. Make sure that you have a grasp of your books. If you're still doing your books, you might want to consider thinking about partnering with a bookkeeper. That's something that I would encourage anybody listening today who's doing that. Reach out to Cliff, and either him and his team would be happy to help out with that, or you might have some partners that he could help introduce you to. Third, which kind of goes with the entity structure, is understanding how to pay yourself. Are you wearing your "I'm a W-2 employee of my business" hat, or am I wearing "I'm the business owner of my business" hat? Because that can create some really attractive tax savings. Fourth is make sure that you're optimizing retirement contributions. And we'd be happy to have a conversation with anybody that's listening today about the pros and cons of setting up each one of these different types of retirement plans. But sometimes, that can end up resulting in tens of thousands of dollars of, tax savings for people, especially in years where they have really big, windfalls. And the last thing, which I think is probably the most important, is make sure that you're working with a tax strategist, not a tax preparer. If your guy or gal only calls you once a year whenever your tax file is, ready to lock and load, you're probably not getting the value that you should be getting. You might even want to just go switch over to TurboTax, quite frankly, because it's probably a lot less expensive than what you're paying some sort of accounting firm that's probably charging you $1,000, $1,500. Spend the extra money, work with a tax strategist, somebody who's going to be proactive and work with you throughout the year to help get that tax liability down. Cliff, was there anything else that you can think of or heard from our conversation today that kind of stood out before we transition over to questions?
Oh man, yeah. I mean, there's just so much. I mean, obviously, I could talk about stuff for a long time. But one of the things too that I think that people get scared about is filing an extension,
Mm,
and you don't need to be scared of that. Okay, that there's no red flags. They're not looking down their nose at you if you file an extension. That's part of the process, and a lot of
mhm,
times it's more advantageous to file the extension
sure.
because it gives you more time if you need it, so you're not stressed. A lot of times you have things that have to finish out, and you need that
Mhm,
time anyways.
sure.
And also, little known fact, actually, it's the opposite of a red flag because you actually are less likely to be audited if you file an extension.
Interesting.
Kind of crazy. It's counterintuitive, but it's true because just like in the investing world, you have first in, first out, right?
Sure.
Same thing. First in, first out for audits.
Mhm,
If you do it early, you're going to be closer in the line. If you do it
sure.
later, you're going to be later. It's going to be less.
Yeah,
Doesn't mean it's not going to happen. It just means it's a lot less likely because
sure.
you're farther down the line. So
Yeah.
interesting thing just to think about. And also
Mhm,
people like double checking. Some people are nervous, like, well, I don't know what they know about me. You can get transcripts from the IRS website if you log in to your account. You can get a transcript that says what the IRS has,
mhm,
so you don't have to second guess. And
sure.
a lot of times you need to file an extension to do that because they come out in like May, April, May,
Yeah,
and so you can double check yourself. And
sure.
so just little tips and tricks. Other thing is if you have changes and you filed an extension, you can file a superseded return instead
Yep.
of an amended return.
Mhm,
And that basically means if you file an amended return, you got two returns on file. And
yeah.
they say, oh, they fixed something. A
Mhm,
superseded return means, hey, it's still before the deadline because you filed an extension,
Mhm.
and you already filed. Now we're fixing something, but it's just going to replace the return that you already
Yeah,
have. So you still only have one on file.
sure.
So just little things and tips and tricks that you don't know, but if you have somebody on your team that knows, then that can be really advantageous to do. And also just helping you plan, because
Mhm.
we're not going to avoid all taxes. You're going to pay taxes,
Yeah.
but part of the planning and strategy is being ready
Mhm.
to pay those taxes so that you're not surprised.
Yeah.
That's really, to me, one of the biggest aspects of tax planning,
Mhm.
because then you're ready. Yeah, I may owe taxes, but I already prepared for it. I
Sure.
have that money. I'm ready to go.
Yeah.
And so,
Well, we're right at time. We probably only have one time for one question. So I see Jaslyn asked a question earlier in the conversation. She asked, "What does a bookkeeper do if you have a private practice?" I'm assuming that's probably a service based, business that she's referring to.
yeah, no, I mean that's a great question. So a lot of times when you are a one man show, right? Then it's like, well, do I really need somebody else to do the books? And sometimes the answer is no,
Hmm.
but sometimes the answer is yes. So
Hmm.
that's something you kind of have to evaluate for yourself. And a lot of times, if you're working with somebody like me, I can help you evaluate
Sure.
that, because I can give you perspective by looking at your books, by looking at how you work, and if this is something that is going to be in your capacity to do,
Hmm.
and or should you get somebody to help you out with it.
Yeah.
And a lot of times, uh, virtually, you can get a bookkeeping service. They also have like virtual assistants that you could
Yeah.
get that do
Sure.
it. Like the world, because of technology, is just
Hmm.
opened up, and so you can just get somebody that's like, okay, well, you're going to be my virtual assistant, and you're going to do my emails or
Hmm.
responses and the
Sure.
bookkeeping. So you're
Yep.
hitting two birds with one stone.
Yeah.
Like, so there's options out there, and
Hmm.
it's all about talking about those options.
Yeah. Yeah. It's good. Well, as we wrap things up here, I'm going to drop a link in the comment bar. Next month, we are going to be talking through actually what we've talked about a little bit today, which is how to think about cash flow for your business. We're going to be bringing on James Wren, who has about a 30-year background as being a CFO of different financial organizations, and so we're super excited to have James. That'll be a part of our conversation. That's going to be next month, April the 10th. That's going to be a Thursday at 2 o'clock. You can see the link in the comment and then in the comment bar. And then you're also able to take a picture of that QR code and it'll bring you to the link to go ahead and get registered for that. We'll also send out some information as a follow up to our conversation today. Cliff, just want to thank you again so much for jumping on during busy tax season and sharing some of these great insights. I hope that it was really helpful for everybody who was able to jump on and be a part of the conversation today.
Thanks for having me.
Thanks.